Welcome to Chapter 1, the Accounting Equation.
Just a quick reminder about essential outcomes. Make sure that you have a good understanding of transactions that affect the accounting equation. 1-2 Accounting Terminology. A transaction is a business activity that changes assets, liabilities, and/or owner's equity. An account is a record that summarizes all the information that pertains or relates to a single item in the accounting equation. An account title is the name that is given to each account. The account balance is the amount that is in each account. The capital account is the account that is used to summarize the owner's equity in a business.
The accounting equation must always be in balance. Assets must equal liabilities plus owner's equity. So, the total of the amounts on the left side must always equal the total of the amounts on the right side. Before a business starts, its accounting equation will show all zero balances. It is now time to try and practice recording transactions underneath the accounting equation. What we want to do here is show whether an account is going to be increased or decreased by a transaction. So let's look at transaction 1, August 1st. Receive cash from the owner as an investment, $5,000. So let's first identify our keywords. We receive cash, so we know our cash is a keyword and it'll affect our cash account. Another keyword is the word investment. Whenever the owner invests into the business, it will directly affect our capital account. When we receive cash, cash will increase the cash account. And whenever the owner invests into the business, the investment will also increase capital account. So to record this, we are going to write August 1st underneath the account titles. Underneath the cash account, we're going to write plus $5,000. We're going to go to the capital account on the right side and write plus $5,000 since we said both of these accounts will increase. Underneath the explanation column for the capital, we will write investments. Whenever we use the capital account, we need to identify and explain the purpose of that account. Now it is time to determine our new balance for each account. We are going to add $5,000 to the zero in the cash account, and we will get a new balance of $5,000. Supplies, prepaid insurance, and accounts payable supply depot, we will simply carry the zeros down into the new balance lines. In our capital account, we are going to add $5,000 to the beginning balance of zero, and our new account balance will be $5,000. Now it's time to check to make sure assets equals liabilities plus owner's equity. So if we look at the asset side, we have $5,000 plus 0 equals 5,000. On the right side of the accounting equation, we have 0 plus 5,000, which is $5,000. So assets do equal liabilities plus owner's equity. Transaction 2, August 3rd. Paid cash for supplies, $275. Let's decide on our keywords. Paid cash. What did we pay cash for? Supplies. Whenever we pay cash, we have less cash, so our cash account will decrease. What did we get cash for? Supplies. Since we have more supplies, our supplies account will increase. So let's record our transaction. We're going to write August 3rd. In the cash account, we're going to write a minus 275 to show that our cash account is decreasing. We're going to go to our supplies account and we're going to write plus 275 to show that we have more supplies in our business. Notice that in this transaction, only one side of the accounting equation is affected, and that would be the asset side. Whenever only one side is affected, you must have a minus and a plus in order to get the accounting equation to balance. So let's determine our new balances. We're going to subtract $275 from the $5,000 cash balance, and our new balance after August 3rd is $4,725 in our cash account. We are going to add our August 3rd $275 to our zero balance in our supplies account to determine our new balance, which will be $275. Since our prepaid insurance still has a zero balance, we carry the zero down for our new balance. Accounts payable still has a zero balance, so we'll bring that balance down as zero. And our capital account is still $5,000, so we'll bring our $5,000 down. Now we need to prove that assets equal liabilities plus owner's equity. So we're going to add up our asset accounts. $4,725 plus $275 plus 0, we will get $5,000 for our assets. Then we're going to go to the right side and add liabilities, which is 0, plus capital, which is $5,000, to get $5,000. So assets $5,000, liabilities plus owner's equity $5,000. Our accounting equation is in balance. Transaction 3, August 4th. Paid cash for insurance, $1,200. Let's find the keywords. Paid cash. What did we pay cash for? Insurance. We know that for paying cash, we will use the cash account. And because we have less cash, the cash account will decrease. The account that we will use for insurance is called prepaid insurance. The prepaid insurance account is an asset account for the purchase of insurance for the business to protect the business against loss such as fire, water damage, and building destruction. So let's record our entry. August 4th, our cash account will decrease by $1,200. Our prepaid insurance account will increase by $1,200. Why? Because we have more insurance. Let's determine our new balances. The cash account new balance, $3,525. Supplies, $275. Prepaid insurance, $1,200. Accounts payable depot, 0. Kimpart Capital, $5,000. Notice once again that the August 4th transaction only affects one side of the accounting equation. Now it's time to check to make sure your assets equal liabilities plus owner's equity. If they equal, go on to the next slide. Transaction 4, August 7th. Bought supplies on account from Supply Depot, $500. Let's look to see which two accounts are affected. We bought supplies, so we know our supplies asset account is affected. And we bought the supplies on account, which means we've incurred more debt, which will affect our liabilities. Since we have more supplies, our supplies account will increase. And since we've incurred more debt, our accounts payable supply depot will increase. So let's record our transaction. Supplies plus 500. Accounts payable supply depot plus $500. And now let's determine our new balances. Cash, $3,525. Supplies, $775. Prepaid insurance, $1,200. Accounts payable supply depot, $500. Kim Park Capital, $5,000. If we check to make sure our accounting equation is in balance, we are going to add up our three asset account balances and come up with $5,500. Then we will add up our liabilities plus owner's equity. So we will add up our two accounts and we get $5,500. Our accounting equation is in balance. Transaction 5, August 11th. Paid cash on account to Supply Depot, $300. Let's look at the two accounts that would be affected. We paid cash, so we know our cash account is affected. We also paid cash on account to Supply Depot, which means that our debt is decreasing. So debt is equal to liabilities, so we know our liability account will decrease. The two accounts affected, cash and accounts payable, Supply Depot. So let's record our transaction. We will write a minus $300 underneath the cash. We will write a minus $300 underneath accounts payable, Supply Depot. And then now it is time to calculate our new balance. Cash, $3,225. Supplies, $775. Prepaid insurance, $1,200. Accounts payable, Supply Depot, $200. Kim Park Capital, $5,000. It's now time to check to see if our accounting equation is in balance. Add up your three asset accounts so you get the new total for all three accounts. Then add up your account balances for liabilities and owner's equity to come up with a total. Compare the two totals, and if they equal, the accounting equation is in balance.
We have just finished 1-2 or part 2. Now we're going to do our work together. Please open your book to page 13. You will also need page 7 of your working papers. Complete the assignment. If you have questions, feel free to ask. We have just finished part 2. Please make sure you have your part 2 activity reviewed by your teacher, and then please access the part 3 video.